So our topic today is on depreciation. And depreciation, as you may be aware, is the loss in value. So when you are talking of an asset could lose value because of several things. Could wear, tear. Sometimes you need to change parts or what we call maintenance, etc. So by definition, we say depreciation is the loss of value of a non-current asset. Non-current assets are fixed assets, or those assets that will be used in the farm for a duration of more than 1 year. So when that asset loses value throughout its period while in use, we call that depreciation. We have international accounting standards that talks about the depreciation of property. Yeah, and that is the International Accounting Standard 16. Talks about the PPE. The PPE that you people know could be the one for COVID-19. But when we talk of PPE in accounting, we are talking of property, plant, and equipment. So depreciation is that once an asset loses value, remember in accounting, we have to show the true and fair view of the accounting of the business, and this is in monetary terms, or the material. And when we talk of the material, we are talking of the value. So when an asset loses value, the depreciated amount is supposed to be shown in the financial statement. So that amount, or the depreciable amount of that asset over its life, is what we are calling the depreciation. Now, under the matching concepts, we said that all the incomes and revenues and also the expenses of a particular period are supposed to be reflected in the financial statement. And because depreciation is an expense, it should also appear in the profit and loss account, or rather the statement of income and expenditure. We have the causes of depreciation, could be due to physical factors, and physical factors will be wear and tear. Of course, we expect that over time, machinery, motor vehicle will wear and some parts need to be replaced. For example, tires. When you drive your vehicle day in, day out, there will be that wear and tear, some spare parts, etc. If it is not moving, some metallic radicals may rust, may decay. When something is fixed to the fabric of the earth, for example, machinery, over time, they'll get rust and they'll start depleting or decaying. Then the second one is economic factors, and this will be loss that occurs when a business grows or expands, and they can no longer fit in the space, for example, they were in, and they may require a bigger space. Then due to technology, we have some machines. For example, in 1990s, we were using desktops. We were using Windows 5 or Windows 7. So back then, these systems could be used, but over time, technology advances, and therefore the latter or the former becomes, the former technology becomes obsolete. Then the third cause of depreciation is due to time. Some assets will have some legal fixed time. For example, if you are having a lease of 5 years, we expect after 5 years that asset will have expired, or the lease will have expired. Then of course, depletion. For example, mines. If your business is, let's say, extraction of minerals from a quarry, we expect after some time that quarry will deplete. All the minerals that are there will be used. In financial reporting, we call them royalties. So royalties, they'll be given for a duration of time, over which you are supposed to have extracted what was agreed upon. If that is not the case, then it will appear like your lease has expired, and therefore, even if you had not depleted the mines, you could lose a chunk of the business because of your, of course, time factor. Then we have the methods of depreciation. How do we account, or how do we ensure that whatever we are reducing the value of the asset with is the fair value? Of course, through validated tests, you've come up with several methods of calculating the depreciation, and they are highlighted here. We have sum of digits methods, we have revaluation methods, which applies to non-current assets of low value. And revaluation is, for example, people believe that land will increase in size, will increase in value, or what we call the amortization in better accounting terms. So when we are talking of the revaluation, could increase or decrease depending. For example, a car, if you take a car to the insurance company and you want to get some insurance cover, they are going to do a revaluation. You do not really expect that car to cost the same value it was costing when it was new or in the previous period or year. Then you have what you call the machine hour method, and this is based on the number of hours that a machine will be expected to operate. Then you have unit of output method, and this depreciation is based on the number of units a machine is expected to produce. Of course, we expect that there will be some wastages or idle time, but there is a way or the mechanism, and this one will be taken in your cost accounting in the later period. Then we have the depletion of units. I've said depletion of units will be used in royalties. So in the royalties accounts, there is something we call the short workings. So when you get there, that will be third year, second semester, and some will take it in fourth year, first semester, depending on the program. So the most common ones that we use in accounting at this level, we have what we call the straight line method, and we have the reducing balance method. So the method chosen by the firm should be in accordance with the agreed accounting principle. Remember, the International Accounting Standard 16 stipulates that if a firm agrees that they'll be using straight line method, that should be the method that should be used consistently. By consistency, I mean, we do not expect that you are doing it for, let's say, 1 year, in the year 2021. This year you use straight line method, let's say. Next year, you start using reducing balance method. At the end of the third year, or for comparative purposes, we may lose because you compare equals. And that is why the accounting standard, International Accounting Standard 16 emphasizes on consistency. That if a firm chooses one method, then it should be used consistently. So in this case, I want us to look at the straight line method. I've said is one of the methods that we use or you'll be using at this level. And this method ensures that a uniform amount of depreciation is charged in the statement of income and expenditure for particular assets, and we follow the formula that is highlighted there. And we are talking of the depreciation for the given year as being equal to the cost of assets. We less the residual value or the scrap value over the estimated useful life. So when we are talking of the cost of the assets, we are talking at the cost that we acquired that asset at. Residual value is the scrap value or the amount of the firm expect to sell if they want to sell. For example, if you purchase a motor vehicle, let's say at 1 million, and you expect to sell it at 500,000 after 5 years, then your 500,000 is the scrap value. So it is the estimated sales value. Of course, now the estimated useful life, this is the period the asset is expected to be used in the farm. Could be 3, could be 5, could be 10 years, depending on the nature of the assets. Now you have an example here. A farm buys a machine of 100,000. It expects to use it for 8 years, to use it in the farm for 8 years. After 8 years, the machine will be sold at 20,000. Therefore, under the straight line method, we say that you are going to take the cost of the asset. So the cost of the asset is 100,000. We less the residual value or the sale value, and our sales value is 20,000. What you expect to sell at after 8 years? Of course, the estimated useful life will be 8 years. In other words, our depreciation per year will be 10,000 pounds, which means that when we go to the profit and loss account, our depreciation expense for the machine will be 10,000 every year. So straight line method assumes that you accrue equal benefits on the use of the assets, and then it spreads the asset over its useful life. Yeah. For example, buildings. A building, if you have a building today and you are using that building to do your business, we do expect that that building will stay unless you do some capital expenditure or you do some expansion or restructuring. So we assume that that asset will accrue equal benefits over the duration it will be used by the farm. Then you have the reducing balance method. And as the title goes, reducing balance, the farm determines a fixed percentage rate that is applied on the cost of the asset during the first period of use. Then the same rate will be applied in the subsequent financial period, but this will reduce the value of the asset. So we are talking of the cost of the asset less the total depreciation that will be provided as at a given date. So the method ensures that the higher amount of depreciation are charged in the profit and loss account in the earlier period. The assumption is, for example, if we have a plant and machinery that is being used in the farm, it will be more efficient when it is new. As it ages by, or as the year or the period goes, the machine will start losing its efficiency by and by. So in the initial period, we are going to charge you more depreciation. As the asset ages by, its functionality and its efficiency also is reducing. And that's why we are talking of the reducing balance method. For example, let's assume we bought a machinery for 100,000 and the provision for depreciation is 20% per annum on a reducing balance method. It therefore follows that in the first year, our cost of machine is of course 100,000. Our depreciation is at 20% per annum. So 20% of 100,000 is 20,000. So in the first year, we are going to reduce all the provision for depreciation in the statement of income and expenditure will be 20,000. So coming next year, we are going to take the net book value of our machinery at 80,000. 100 minus 20. So it will be 80,000. So again, we depreciate it for the second year. 20% of 80,000 is 16,000. So you are going to get again 16,000 for the second year. Our balance when we'll be opening the third year will be 64, or rather 80 minus 16,000. And therefore, once we depreciate for the third year, then you are going to get depreciation in the third year as 12,800. That is 20% of 64,000. So the balance in year 4 will be 51,200. That is 64,000 minus 12,800. Yeah. In other words, the reducing balance method diminishes the value of the asset, and it assumes the benefits accruing from the use of that asset will be higher in the initial period, and then it diminishes as the period goes by. This method is best used for fixtures and furnitures fittings. Of course, if you buy a chair today, you don't expect the status of the chair to be the same 5 years down the line. Same case to plant and machinery, same case to motor vehicle. Now, how do we treat depreciation in accounting? We are talking of the fixed assets or the non-current assets. They are the ones that are depreciated. So we'll be debiting our profit and loss account and crediting the provision for depreciation account, because we are really providing for depreciation with the amount, of course, that will be depreciable in that period. And the entries will be, for example, in our latter case, where we've depreciated the machine using the straight line method, let's go back. Our depreciation for a year was 10,000. So we would expect that when we go to the entries, we are going to debit our profit and loss with 10,000, and then we are going to credit the provision for depreciation of the machinery at 10,000. Are we there? We'll have a better example and see how it pans out. So when it comes to the final books of account, our plant and machinery is an expense. So we'll go to the plant and machinery, and then the depreciation, because it's an expense, will be reduced. Then in the balance sheet, we are going to have the non-current asset, which is now machinery. Our cost was 100. The depreciation is 10,000. So our net book value in the first year will be 90,000. Let me see. Yeah, it's not stipulated, but that's what will be happening. I have an example there. It's a worked example. I want to give I have an example here. I think we can work with this. This will be presenting our scenario better. So you have a company that starts business on 1st January 1999. The financial year end being 31st December, and we are required to show the plant account, provision for depreciation account, and then the balance sheet extract for the years 1999, 2000, all the way to 2002. So you can see the machinery was bought on January 1999. We have another machinery that is being bought on 1st July 2000. And then we have another one that cost 6,000 being purchased in 1st of October. And then going to year 2002, we have another machine that is being acquired at a cost of 2,000. Then we've been told that depreciation is 10% per annum. We are using straight line method, right? We've been asked to prepare the plant account. Let me open an Excel sheet. Let me stop sharing this and put let me copy paste that example in an Excel sheet, and then we work from the Excel sheet. So that will give us a better view. There we are. Let me share the Excel sheet. So there is the question. We start with the plant account. The examiner has asked us to prepare the plant account. Yeah. So plant account, I have the dates here. Details. I have the amount. That's the debit side. And of course, the same case will apply to the other side. So I'll copy and paste. So this is the debit side, this is the credit side. Trying to make it look like an account for purposes of illustration. So there we are. I have the plant account and I have the dates. We are assuming that we are going to buy by cash. Let me do the journal entries here. So I expect once I buy the machine, I'm increasing my machinery. So I'm going to debit plant. I'm going to debit plant account and I'm going to credit cash account. But the examiner is asking of plant account. So I'm not intended to do that. So this is the year 1999. So this is 1st January 1999. So I'm buying that machine by cash. And you can see my cash is reflecting there. It is 8,000. Yeah. So that's the machine. So I'd expect if I go to the cash account for double entry, I'm supposed to go there and do the crediting. My cash is decreasing. It's an asset. When asset decreases, we credit. So debit the cash account, debit the plant account, and credit the cash account. But for this case, I've said I'm interested in the plant account. We go on. Then in the year 2000, that was 99. I would have indicated here it's the year 1999. So that it becomes easier. Then I go to the year 2000. And in the year 2000, you can see what is happening. Yeah. In the year 2000, I'm buying two plants. I have one that is costing 5,000 and I'm acquiring it on 1st July. The other one I'm acquiring it in. But before that, because I didn't acquire any machine here, then in the year ending 31st December 1999, I go ahead and have a balance. Go downward, carry downward, so that I close that book. And the balance will be 8,000. So that when I open my year here in January, now the year is 2000, I'm going to have the balance brought downward of 8,000. Then in the course of this particular year, on 1st July 2000, I'm acquiring the second plant. Again, I'll assume that I'm buying cash. Yeah, so the second plant is costing, no, it is two plants, isn't it? Two plant costing 5,000 each. It's not one plant, two plants costing 5,000 each. which means the value will be 5,000 multiplied by 2. Then, same year, 1st October, I'm acquiring another machine. Again, I'll assume I paid cash for purposes of documentation, and the machine is going for 6,000, right? I'm not buying any machine yet. I'm not selling any yet. So I want to close my books. It is at the end of the year again, and I want all these requirements. The requirement that the company should prepare books of account at the end of every period. So my balance here is 24,000. So I'm closing my book at a value of 24,000. Yeah. So my balance carried downward is 24,000. So coming to the year 2001, I'll have on 1st January 2001, I have a balance brought downward of 24,000, right? Then in the same year, on 1st April, I'm acquiring another plant that is costing 2,000. So again, I'll assume cash transaction 2,000. Yeah. And there is no any other machine that I'm buying. Therefore, I'm closing my books. It is on 31st December 2001, and I'm closing my books, and therefore the balance to be carried downward will be this 24, this 26,000. So I'm closing my books at 26,000 in the 3rd year, and therefore that becomes my final accounts. So you've seen what you've done to put these balances in a manner that shows we are accounting students. If you have any question, do not shy away. Kindly post the question in the portal. I'm going to answer all those questions promptly. So there we are. I didn't close this book. We close it, balance, carry downward. It's 10,000. What am I doing? This one is not supposed to be the case. Format painter. I think I'm the one who is contradicting himself by trying to do other things. So that's where we are. From the examiner's request, the second one is provision for depreciation account. In other words, we need now to calculate the depreciation. Yeah, I want us to calculate the depreciation. And let us start with the year. I'm going to work on this side for everyone to see. Let us start with the year 1999. Our depreciation, we've been asked to use depreciation at the rate of 10% per annum using the straight line method. So you're using straight line method. So the value of the asset in the 1st year is 8,000, right? So we are going to multiply by 10 divided by 100 to get the depreciation for the 1st year. So my depreciation for the 1st year will be 800, right? So let me have a column here and call it accumulated depreciation. accumulated, where I'm going to record now the year-to-year totals for purposes of tracking. So that is year 1999. So I come to year 2000. In year 2000, I have a machine that I acquired. I have 2 plants that were acquired on 1st July, right? So on 1st July, I'm going to acquire 2 machines at the cost of 10,000. So I multiply by the depreciation rate. So this will be giving me, but be cognizant of the time. So I'm going to have multiply by, it is bought in 1st July. So it is like half an year. So because we have 6 months to end the year, right? So kindly note that. So this will give me 1,000 divided by 2, that is 500, right? In the same year, 1st October, again, I'm acquiring another machine. Depreciation is still at 20% per annum. But for this year, I'm going to have only 3 months. We are in 1st October, right? Is it 3 months, 4 months? Because I'm going to have October, the 3 months, October, November, and December. So I'm going to multiply by 3 over 12. That will give me 600 multiplied by 3 over 4. That's like a quarter. So I'm going to get 150. So there we are. Don't forget that our first plant has not been sold yet. So I'm going to depreciate it for the second year. So multiply by, what was the value? 10 over 100. But this year, it is a whole year. So multiply by 12 over 12. So again, I get 800. So if I get the cumulative, my cumulative, sorry, escape. My cumulative for year 2000 will be 1450. So this 1450. The first year I had 800. Then I go to year 2001. In the year 2001, I'm acquiring 1 plant on 1st April at a cost of 2,000. So again, multiply by 10%, then multiply by, we are acquiring it in 1st April. To mean, we'll be covering like 3/4 of the year, 9 over 12. 9 over 12, that is 200 multiplied by 3 over 4. What do you get? What do you get? What do you get for year 2001? This will be 15, right? Then don't forget to accumulate the other machines. So we have the other machines that are now taking a whole year. So a whole year to mean I have the machine that costed 10,000, 2 plants that costed 10,000. I add the one that costed 6,000. I add the one that costed 8,000, right? So this gives me 24,000. So 3 plants, 3 or 4 plants. So I can depreciate them all together instead of calculating each and every one. So multiply by 10% per annum. Then it's a whole year. So this will be 2,400. 2,400. So I can get the cumulative for this year. It will be 2415. So 2415 will be accumulated depreciation for that year. In other words, if I add the totals, I'm going to get the accumulated depreciation is 46.50, 46.65, 46.65, 46.65. Any question? Any question? So that is year 2001, sorry. Actually, in the year 2001, this is the time I'm noting here. Look, and the examiner can be cunning at times. So you can see what is happening. It is not year 2001, actually. This year 2002. This year 2002. Yeah? To mean this whole year, I'm just supposed to accumulate the, is a confusion. Let me cut this. It's a whole year. Yeah? It's a whole year for 2001. And in the whole year, I'm just doing the accumulated, I'm just doing the depreciation for the machines that we acquired from the year 2000, from the year 1999, one plant, and then for the year 2000. So I'm doing for 4 plants only. So this one is not even supposed to be here. Cut. This should come in the year. So bear with me. This is year 2002. Was a confusion. In other words, the accumulated depreciation for this particular period would have been 2,400.